Hi, I'm Andrew Jordan with NodeWise CPA. A lot of business owners assume that once a tax return gets filed, everything just rolls forward cleanly into the next year. And sometimes, honestly, it doesn't. One of the things we look at every year when preparing a tax return is whether the equity actually ties out from the prior year return to the current year return. So at the end of one year, maybe the tax return shows $500,000 of equity. Well, that exact number should normally carry into the beginning of the next year. And when it doesn't, the question becomes what changed? Now, sometimes there's a completely reasonable explanation. Maybe bookkeeping got cleaned up after the tax return was already filed. Maybe additional expenses were entered later. Maybe something got reclassified. That happens. But what I sometimes see is firms making a large adjustment to retained earnings just to force the return to tie out and move on. And if it's something tiny, that's usually fine. If there's a small difference under a few $100s or something, I'm not saying anybody needs to spend hours researching that. But I've also seen situations where the differences were much larger than that. And when that happens, we don't just plug an adjustment in and move on. We stop and figure out what actually happened. Because sometimes there's a legitimate explanation, but other times something was missed. Maybe income wasn't reported correctly. Maybe deductions got added later. Maybe the books changed after the return was filed and nobody really reconciled the difference properly. And the reason this matters is because eventually other people may start to look at these numbers too. Banks look at this stuff, buyers look at this stuff. And when somebody sees large, unexplained equity adjustments year after year, it raises questions about how reliable the financial information really is. And honestly, one of the worst situations for a business owner is sitting across from a banker, investor, or buyer trying to explain an adjustment that they didn't even know existed. Because most of the time, nobody ever explained it to them. It was just something done quietly in the background to make the return work. And just to be clear, I'm not saying this is some unethical thing. This is actually a pretty common practice in the industry. We just think there's a better way to handle it. That's one reason we prefer working with clients throughout the year instead of only touching the business at tax time. We want to understand what's actually happening in the books while it's happening. Because usually these kinds of issues don't start with one giant problem. It's normally a bunch of smaller things stacking up over time. And this is one of those details most business owners would never even think to ask about. But sometimes the things nobody is talking about are the exact things that end up mattering later.